Right, you're welcome. This is Felix Smith as a Jimo. So pay attention. You subscribe for Plan B Express Cash Flow Solution Club. And of course, you're a member of Felix Forest Inner Group, Inner Code. In Now, I'm going to be teaching you something called precision, trading precision. So there are three pillars of precision entry in the market drawn from Felix P and L trading strategy. Now, quickly, I'm going to theoretically explain to you, and then over time, you have access to this script, and you can study more. So, a constant entry means minimizing the required price movement to your stop loss to validate your trade idea, thereby maximizing your risk reward ratio, RR. This is achieved through three stages. Trading is all about what or where, why, and when. So, what should I trade? All right. What should I trade or where should I trade? What exactly am I to trade? Will have to do with the instrument and so which has to do with context. Then you will now look at okay, why will I trade? If I want to enter this trade, why? Which has to do with confluence. I trade confluence a lot. Then next you want to look at it when then. So when should I now find a trade? But you need to define trading style. I use scalping. So if you are scalping, you are looking at your higher time frame at 15 minutes and your lower time frame at maybe 3 minutes or 1 minute. So let's make it this way. M3. Okay. So let's make it M3 slash M1. Because sometimes some market or some instrument volume may not be too big. So lower time frame, like 1 minute precision may not work. Especially you are trading like volatility index. Maybe you are trading on well trade and all the like. So, but it's the same principle, but it's just the volume and then so the liquidity that will be available may not be able to give you precise answer. Then day trading that you're working with 1 hour, 30 minutes, 1 hour or 30 minutes and 5 minutes. So your higher time frames will be 1 hour or 30 minutes, depending on how the instrument works. Why I have to say this that when you start trading, you're going to find out some instruments may not have so much volume to be able to measure with your standard. So you have to evaluate all of these things so that you're able to achieve the right answer. Okay. Then intraday trading, you're working with daily time frame of 4 hours. All right. So mostly you're looking at your 4 hours and then 1 hour, right? Or 15 minutes. So most time you want to work with that, you can actually go. So if you're working on daily time frame, you're working with 1 hour as your entry model or lower time frame. Right? Swing trading has to target with weekly and all the like. Now, these three items, number one, higher time frame. So the where. So the answer of the where or the what. All right. So let's call it the what or where, which is high probability zone. You have to identify the context at which you want to be establishing some of those things you're looking for. So this is the concept. So precision begins on the higher time frame. So you shouldn't look for entry until the price enter a predefined point of interest. So first of all, you have to identify point of interest. But now this is the point. You can identify point of interest without going with your bias. So that means your context has to do with a higher time frame to identify two major things, the trend of the market and the point of interest. So take note of this. Your higher time frame is to identify the trend of the market, that's the overall trend, or at least for the context of your trading. Because when you say overall trend, we still have daily time frame, 4 hours, monthly, and so you don't want to go to that. You are looking at the context of your trading. So your context of your trading, maybe you are a swing trader or you're a scalper and all of that. So of course, your higher time frame is going to 15 minutes. And that same 15 minutes that you're using for your higher time frame is the entry model or time frame for someone who is intraday. Do you understand? So you have to understand this because most time when people tell you higher time frame, I see a lot of people, you're a day trader, a scalper, intraday trader, and you're looking at weekly time frame. What are you doing there? There is no point to be very serious. Yours is to take some chunks of the thing and leave the market. So you do not have time. The fact the highest time frame you have any business to do with as a day trader, as a scalper, you know, it should be daily time frame. And you shouldn't waste too much time on your daily time frame. So let's quickly, I want to make this as simple as possible. So identify point of interest. So this is what? Define critical zone where smart money, that institutional, order flow is expected to interact. These are often unmitigated order blocks. UOB. You may not find UOBs anywhere. That's my own label. The last up or down, candle before an aggressive impulsive move. Now, when you're going to be defining demand zone too, it's commonly related to this, but most time where people pick demand zone because of the beginning of a trade, the beginning of the move may not necessarily be a demand zone. But what initiates a massive move, it now be demand zone. So you have to understand. Now, market was choppy at the point, and then all of a sudden you have an aggressive candle move. That last candle before that, it could be bearish, it could be bullish. It doesn't matter. But that's your demand zone. That's when there is an aggressive takeover of the trend of the market. You understand? Okay. So now let's quickly look at this aspect. So now you want to look at the fair value gap. That's an imbalance. Price void. That signal inefficiency delivery. All right. Acting as a magnet for price to return and fill. Then we have the liquidity kind of a thing, engineer liquidity. The area where price, is expected to sweep retail stop losses, equal high, equal lows, or swing high, swing low, and all of those things. And then the other PDRAs, other areas of interest such as Fibonacci levels, demand and supply zones, liquidity void, breaker blocks, where price is expected to mitigate before a major move. So these are point of interest for you. Then, so in these, but for you to even ascertain your point of interest, you want to define them, all right? The bias, which has to do with the higher time frame, like I've said, the trend, all right? And only look for entries that align with that trend when price hits your point of interest. So this is checking the structural bias along with the recent break of structure. So we're going to be doing this in the chart quickly. So the consciousness and awareness, okay, why do I need to buy at this point? Now for the fact that this is the point of interest, right? Which is the context. Now the market had returned there. So why will I buy? So which has to be confluences, all right? So your entry must be concise, meaning it must be validated by multiple factors, which are confluences, all right? The more reason you have to enter a specific price, the tighter your stop loss can be. Just a moment. All right? So like I said, all right, your entry must be concise, meaning it must be validated by multiple factors. The more reasons you have to enter a specific price, the tighter your stop can be. Okay, now, so for instance, an overlap. Look for zones where two or more POIs overlaps. The strongest entry is often found where there's an FEG, sit within a mitigated, a non-mitigated order block or a breaker blocks or liquidity area. So for instance, a market come and sweep liquidity. Now, let's look at an example. This is a practical example. So this is your market structure. Market was moving, break a structure, then return back again, probably to mitigate this area. Make a lot of sense, right? Then you have another break of structure. So the market have traveled down. So this is a break of structure, and the market has traveled down. Then we have this other block, right? This is another block, and then we have a fair value gap. Make a lot of sense. So the market reacted to the 50%, which we'll call an encroachment. All right. Now, so the market had rejected at this point. Now, I use more conditional activities like power of 3. And then you could see this is a rejection, and then this power of 3. Now, if you are waiting so much, you probably want to wait for this candle. This is 1. This is accumulation manipulation, and you want the distribution to have started and give you more assurance. So some want to enter the market here, and their stop loss probably above here, but more safer stop loss is usually above the candle that causes that fair value gap. So that means your stop loss should be above this candle to be safer. And then the market anyway travel, and you are marking 1:2 risk reward or 1:3 risk reward. Sometimes you are looking at the draw of liquidity, which is here, and then the market delivers. Now the same thing, look at another example. Market has recorded this low, and then we have another high here. So market travel will return back to this point, and you have a break of structure. In this break of structure, you have another block, which is this. This is bullish order block, and then you have a fair value gap in between. All right, then the market will return back to this is a very high probability. Now, if you enter here at this rejection, all right, some may wait to enter here. This has been mitigated though. Now, here, your stop loss most time supposed to be below this long candle that caused that fair value gap. So most traders that are highly conservative take their stop loss below even the total order block, and then targeting another draw of liquidity, which can be here or another place here. Do you understand? All right. So explore time of time of trade. Trade during period of high liquidity. I always tell people, e.g., London open, New York open. So entering outside this often lead to choppy price actions and unnecessarily wide stops or delay delivery of your target. So sometimes that does not mean that you cannot find a trade when there are no sessions, but there are no liquidity, buyers and sellers. So higher time alignment, higher time frame alignment, only consider entry when the market structure on the higher time frame is confirming your buyers, e.g., break of structures to the upside or a long entry, right? For a long entry. Now, precision. So this is now when should I now enter? All right, look at it. So once price enter your high confluence POI to drop to a lower time frame, e.g., 1 minute. So you need to know. All right, if you go back to the beginning of this interaction, I told you about, are you a scalper? So what was your higher time frame and what's your lower time frame? So what exactly am I looking for in this lower time frame? In this lower time frame, we are looking for MSS, market structure shift. So do not enter immediately upon contact. Wait for the price to show it ends. All right, look for this. So now let's quickly look at the chart. Let's take an example of a chart. Now, so this is a chart. Now answer me this question. If this is 4-hour time frame, if you are trading on 4-hour time frame as your higher time frame, so what should be your lower time frame? 15 minutes, because you are an intraday. But there is a time you're actually blending some of those things, but don't mix things. But you are not going to be over static, because sometimes when you go to 5 minutes, it can give you what you're looking for early. Now let's look at this market. This is Ethereum, for instance. Now you could see Ethereum overall before was a downtrend, okay? Ethereum was what? A downtrend. So let's look at it. You could see that this was a downtrend of 4-hour time frame. So Ethereum got to $4,700 thereabout and measure up. And so if you look at this, so let's quickly do something very quickly here. Now, this market was going up here too. So just using this context. So here to here was a downtrend, was an uptrend. So what happened is this. Look at this market got up here. This is a break of structure. And then this another high. Then there was liquidity sweep. So this market sweep liquidity. This is a liquidity. So which you can say a buy side liquidity. It has been swept. And now what market did was that to take out this low, after sweeping the liquidity, there was a break of structure. Or you can now say shift. So this is a market structure shift. So it's very simple because the market was traveling up. This used to be a very good A+ entry as a reversal point. Now this market travel up here. We have a high and we have a low here. And then we have a sweep of liquidity and travel and take out this. This will make a lot of sense. Now, ordinarily, this market was supposed to be like, this is a high, a low, another low, another high, another low, another high, another low, all right? Another high, another low, another high, another low, right? Then we have another high here. There's another low here. So what you expect was that the market actually could go up, all right? So, and break structure, which has done that. And after breaking the structure, this is supposed to be the market now travel back to this point and then maintain this other block. So let's quickly look at it. This is supposed to be another block that's supposed to, the market's supposed to come back to and mitigate and go up, right? But here it has swept liquidity, and this is another block. This become a breaker block, right? And so the market broke this, and this other block become a breaker block. Make a lot of sense for reversal. And now here the market actually returned back to the origin. Now you expect the market to come here? No, the liquidity have been swept here. There's a break of structure here, which is like a market structure shift as it were. Now, so as the market come back here, so this is a point of origin and this is a point of interest. So when you come and the market is somewhere here, you're actually expecting that the market come in. Yes, there's a fair value gap here. So many factors are here. Now the market has gotten rejected here. So you want to go down to a lower time frame to find your conditions to be met. Okay, so the market traveled very well and then continue to trade. And now we are having this now. So let's look at this market here. We are having this. So what exactly are you looking at now? The market has done higher, high, higher, low. But what has happened here is that you now go here. So you are working with this point here. You're working with this. So let's say now this is where most time you mistake a lot of trend line, you draw, and you now say, because the market has given me trend line and then it has broken the trend line, I've short. Okay, so these are other things and problem people create for themselves. Now, so look at this is Ethereum. So I'm using any instrument. Now, so pay attention to me first. We said you want to first of all establish point of interest, and you should do that. You must get your directional bias. So if this is now, this is an uptrend. For now, at this context, this is an uptrend. So if this is an uptrend, so what exactly, how do I mean? Now this is a low and this is a high. So these are structures. All right, can you see now? This is structure broken. This is a high. This is a low. This is a high. Then we have another low here. So that means this low. Can you see what something? See this low? Let me even take it out for you to see. I want you to learn. Now this is a low. This is the lowest after we broke structure here. Why market was coming down all this while. Okay, I'm not going to go into detail of so much for you. Now this is a structure. All right, this is a structure, this is structure, this is structure, this is structure. Do you get it? Now here we come back to this point. So you are not interested even when this market was crashing. Yours was like you're looking at the structure properly. Here the market has broken its structure, and then having broken this structure, there is an origin that initiated that structure that was broken, which was here, right? So here it's another block. Okay, so the market has traveled down or broken out this point. So you're actually waiting patiently. Now this is a structure, is broken. So what you're waiting for is the market to actually travel down here. Do we have any kind of, what do we call it? A fair value gap? So probably you do not have, or you have. I think we have a minor one here. Yes, there's a mild one here. There's a mild one here. Yeah, so you have to look at it. So the market has come into the fair value gap and mitigated it. Then that gives a bounce, right? Now, probably you want to travel down a lower time frame to find a shift. Okay, and these are the things we mentioned. Remember, on your script, we talk about identify point of interest. So here, the market again broke a new structure. Here you have this. This is another structural break. So we have this point of interest, which is another block, right? And then you have the whole place here. You have the whole place here. From this point here up to this point here, down to this point here, is a fair value gap. Have you seen it now? So most time when the market actually give, so it is when the market travel down to this point, you want to see what play out. So I'm not going to go too much detail here. So here we have another break of structure. This is not too useful for us right now because this has been mitigated. So what is more useful for you is what I want to teach you. Okay. So you have another break of structure. You have, so this is like another block. This is like another block. Okay. So here we come back here. So do we have another break of structure? Perhaps yes. So we have broken this. This is a break of structure. Do we have this? This looks like a sweep because we need to have a body. Okay. If I have a body closed, that's a break of structure. I think we do. If we do, fine. Okay. So now pay attention. Now, this is another break of structure. Then we have another block here. Remember, this was not mitigated. So we have another block here. Are you following now? Good, fine. Now we have another block here. And perhaps, this is, yes, this is a break of structure. This was mitigated, right? So this is another block. Now the market has traveled down here. Now, this is fantastic. When the market came down to this point, this was your point of interest. Do we have any fair value gap? Perhaps no. Then you are going to go to 15 minutes, which is your lower time frame, to find what should define your entry. So this become more complex. The complexity of this one is that as all of this point are fair value gap that was not mitigated. So, but what you want to do at a lower time frame is to now find a structural change. I always tell people the simplest way to trade is that when a market moves down or move up, you want to find the market like this. 4 hours, look at it, very simple. Look at 4 hours. This is, let's do this. ATF, LTF. Okay, you see what I want to do? 4H, probably M15. Okay, so let's do this way. This is what you're supposed to be looking at. Since you are trading as intra-trade or day trader, so you know what you're looking for. Now, your structure on 4 hours, your 4-hour structure, and you find your point of interest, a pullback of your higher time frame structure is a downtrend in your lower time frame structure. So this should be well understood, okay? This pullback, this is a pullback. So that's one. So this point is a pullback on a higher time frame. But on a lower time frame, it's a change of structure entirely because it's going to be a downtrend. So when the lower time frame, which is 15 minutes, has changed into an uptrend, that's to confirm your entry. And when they give you your entry, then your target will be this external, which is this buy side liquidity should be your target. So look at it now. Very simple, right? So let's go back. 4 hours. Now let's go to 15 minutes, okay? Now, so what we're looking for is that when the market travel to your point of interest, okay? When the market travel to your point of interest. So what exactly am I looking for? This is actually complex because the market, I think, no liquidity as it were. So here is a low, okay? Now you can see that it actually bottom out of this, your origin, because there's still a fair value gap that the market come to tap in here. Do you remember? Okay. So now, if that is the case, so let's work with this. Here you have a low. Here you have a high. So now let's quickly look at it. If this is a low, and then this is a high, are you following now? So here we have a break of structure, which is a market structure shift. So here, high, okay? And then the market pulled back and actually broke this structure, which is a shift in market structure. Now, so what you want to find is the market that travel back should come and mitigate if any other block and any fair value gap. You get it now? So there is a fair value gap here, and which is this. So market traveling back here on this your 15 minutes. So practically speaking, this is your entry because I use part of 3 into my entry, and at the same time, looking at when the market actually returned back to this origin. So this is a rejection, and then my entry. So now what we say is that when you are entering this market at this point, my stop loss supposed to be below this low. But most traders who are sniper entry traders take it below this swing low at this week. So if your stop loss is going to be here, then 1:2 risk reward target now should be the first place you'll be targeting is the draw on liquidity, which is your what? Which is your sell side, buy side liquidity. So if you're targeting that, that's going to be 1:3 risk reward. You get him now. So if this is the case, you return back to the main structure and then put in this. Because if you stay here, you probably will be fidgeting when anything happens. Then return back to 4-hour time frame to see how the structure is setting up and actually moving towards your external structure, which is this. You get it? Then sometime, if you find a proper market setup, then it's going to give you a very nice, of course, when there's a volume. And that's exactly what you're doing. So very simple thing is that you just need to identify market entry, get your point of interest, and then return back to a lower time frame to identify, most important area of interest. And then that's going to be a very fantastic entry for you. All right. So study this over and again, and then you'll be able to arrive at important entry level. Okay. You get it now? It's very, very important. Most time people don't pay attention to all of these things, and that's why we make a lot of mistakes. Okay. So you have to just identify the structure and then work with the structure as much as possible, and then you're going to achieve what you want to achieve. Okay. So I don't want this video to be too lengthy. In the next segment, I will do so much about emphasizing on the structure. So what you are doing in the market is very simple if you can work with this strategy I've just given to you. It's very simple. But if you are struggling to, then there are other things we talked about in your Forex, if it's your Forex market, is that you need to identify the structure of the market and understand what's happening in the market per time. Because most time people enter into the market without actually defining what they are doing in the market per time. Do you understand? Okay, most people come in and ask me, hey, I don't know what I'm doing. I was trying to get it. I thought and I think and I thought. Oh, no, you don't thought. I thought and I think and I thought thinking all the talking and thinking all the thinking. It's not like that. You have to work with precision, right? So that if you're going to lose, you know why you lose. If you're going to win, you know why you lose. You win and all of that. Precision is one of the major things that you must learn to work with when it has to do with the market. If not, you're going to be giving money to the market, unappreciatively, because every time you'll be wasting your resources in the market and all of that. Okay, so this is an example now. Look at it. This is a 4-hour time frame. This is GBP Chef. Well, I don't take some of those pairs that are popular so that I don't give myself unnecessary stress. Let's look at Euro USD, for instance. So here is Euro USD. Okay, or Euro, yeah, this is Euro USD. Makes sense? Now, so if you look at Euro USD externally, so externally, like you want to sweep much, but if you just take up from a context, you're going to find a structure here, then we have a structure here. A break of structure and the change of character here. There's a break of structure. All right, this is a break of structure. All right, this is a break of structure. All right, this is a break of structure. Now here, the market has changed structure externally. Here you have this break of structure. This makes sense, right? All right, so now if I look at what should be my daily range here, that will be here ordinarily when the market broke this. This is, and then you find this. Because structure was broken here, so you expect a pullback into the origin, all right, which is like this is the other block. Are you following now? Now, so you go to 15-minute time frame, and you're going to find a different thing altogether. And what exactly am I finding? The market has traveled back here. Now, this was more because of activities were changing, and now you have this. The direction has not changed. The market continued to move here. So you have a break of structure here. Now, this is your 15-minute time frame. So you have this. You have a brace of structure here. Then you have this one here. So you have a low here. Then this market structure shift and it travel back to this. Now you don't have a fair value gap, right? So the market travel back to this, and this is a sign of rejection. And then this has given you a buy opportunity. Remember, it has traveled back to your point of interest. Then while you're running this, your target is up here. And so that means sometime when your target is up there, you may get, before getting there, you must have done 1:3 or 1:4, depending on what you must have done, and you're comfortable with that, then you're going to take a trade. You're going to say, okay, I'm good, right? This is like part of 3. And now the stop loss to be conservative sometimes can be below the whole entire order block or just below the swing low or swing high. Then 1:, so if you're going back here, that's about 1:3 point something, almost 1:4, right? So the same thing, if you can find another instrument, let's look at it. GBP USD. Okay, so the same thing you're still going to find, similar thing you're going to find. So if you go to 4 hours, all right, so you're going to be working with your 4 hours just to identify your structure appropriately and then working with what you need to work with. Ladies and gentlemen, this is very simple if you must trade effectively, all right? Now, this can be practiced. Now, let's look at it. It can be practiced on different instruments or different markets. Okay? It can be practiced on different instruments, different markets without any fear or favor. Yes, I tell you that because this is structure and it has to do with market. It doesn't matter which market is that. Either it's a synthetic market and all of that. Let's look at the reef synthetic. Now, one of the challenges I have with synthetic market is that, it's a separate market entirely. And so I have a lot of funny things happening around there. So this is 4 hours. Now, if you look at these 4 hours now, you can see a little bit choppy. Now, where do you say this market is going to? Now, you can invariably say this is a downtrend, right? Because the market was going up from somewhere here. And so if we look at it inwardly, so we can take out this, right? So you can find out that this is a market structure. Okay, this is a market break. This is a low. Then the market has traveled down here and has broken this structure. So this is like returned back to the origin. And so we have a kind of double top and so whatever. All right. So, but now, so that means to say this market, you're looking at where is the external structure here. Now, I don't want to give you so much complex setup. So invariably, you can say, okay, so you expect this market to actually return back to this liquidity, either come to take it or break the structure down. So that means for anyone who have sold here, because look at it, now supposed to be traveling, selling, and all of that. So by the time you go to lower time frame, I only want to see a very clean setup for you guys that you can actually interpret as easy as possible. This this is liquidity volatility, sorry, and they can be very funny. Okay, so if it's a downtrend, it's a high. We have a low here. Then this is high. So this is a market structure shift, something like that. And we have a break of structure, then returning back down. So the question you want to look at now, so where do we go here? So recent break of structure over here. So recent break of structure over here. And then this is a high that give birth to that. So look at it. This is a high. And this is a low. So now you want to look at to what extent is this market going to do? Should I just sell now? You probably want to be waiting. to see when the market, these are funny markets. So you have to understand. So then sometime what you want to do is to like look at your dealing range here to say, okay, this market, taking on PDRA, you get it now? So that means you're looking at perhaps, let's take our single this out. Okay? So you're looking at this market, whatever thing is doing right now may still go down. Then you want the market until when it pull back to this point to be finding an entry. Yes. Can even cross that. You know why? Because there is not proper mitigated fair value gap over here, which is at a premium point. So that means jumping into this type of market now does not really work, okay? So you want the market to actually returning back to this point, and then before you find appropriate entry. Now, so I'm just scanning through all of these things so that you understand that sometime what we take to be this market entered and then the market change. No, because you do not observe what to observe as proper as possible. So this is boom 1000. Now, this is boom 1000 for that matter. When it was crashing like this, a lot did not understand. Okay? So let's take this. So a lot use trend line and all of that. That's not a matter of trend line, guys. So now if you look at this structurally, so here this market, structurally, this is 4 hours. So you have a high here, you have a low here. Then this is another high, this is another low, right? Make sense? So let's look at it. This is break of structure. Then we have this very simple. You see what I'm stretching out? It's like an exhaustion point. So here the market, this is a high, this is a low, break of structure, and then you have what change of character here. So the market have taken out this low. So you actually expect the market to travel up, just like a Quasimodo strategy. So what you expect is this market to actually return back up here. And then so look at the fair value gap. But the market could not get there, of course, get rejected here. So you need to understand interception and overlap. And so we have a rejection there. By the time you return back to a lower time frame, you're going to find, certain levels, certain kind of change of character, probably, and all of that. Now, a lot are relying on this. Now, the deal was done here. It's done here. So then the market has broken. Then this is another breakout. So this is a total breakaway. Market continue to sell. And then we have all of this after a major pullback, another breakout structure, return back to the origin, another breakout structure, return back far off back to the origin. Well, not all the time that the market actually returned back to the origin as you expect. You can look at it here. This is a breakout structure. So what do you see? The market returned back to the origin and actually even sweep that origin as it were. This is like the origin. And this same origin was overlapping again here. Can you see that? So market returned back here. And then you could see a very nice rejection. And then you have another breakout structure here. So the market traveled down. The market is going. So now market massively move. What happened here? There's a proper rejection. And once you find that another sell continue, then this is a breakout structure. Then we have another. So here, what do you have here? This is a fair value gap. Even all to this point. It's as big as possible here. Okay. So if you stop here, it's still the same, but that's as big as that. By the time you measure it, you have the market returning back again, and then another massive sell eventually. So you can imagine how long this market stayed here. So we have another breakout structure here. So this is a breakout structure. So just like a minor last point over here, this one. And so market tap into it. Massive. This is a lovely one. No struggle for this one because now you can get it twisted because this is a downtrend anyway. And then you have a part of 3, and then sold down, and I see if we're returning back up again. So we have another breakout structure. Then we never return back to validate anything there. Then look at continuation. So all this way. So up to now, right? So we have a recent break of structure over here, this down here. And then we have back to this fair value gap. Then probably this another break of structure. So as far as this guy is concerned, still a sell or fair value gap. Another break of structure there, here. Then continue selling. Now, one thing is that you'll not ask me, Feli, can you sell now? No, I will wait if this market is going to pull back to be able to find another opportunity. So, ladies and gentlemen, this is very simple for you. So, the same thing on well trade, you can find trade in all of this, but this is just like you will need to be careful if you are trading with well trade because the structure does not respect like that. So, you can be on at a spot for as long as possible. For some trade you think that had played out very well, we mess you up eventually and all of that. So, but in all said, it's always good to trade it on a higher time frame. Okay, 1 hour daily time frame, right? Stuff like that. Okay, so because if you look at this now, this is a break of structure, right? We have a break of structure here. This is an origin here. So you want the market probably to reject here again before you find another sell. So let's hope that you could find that. Look at it. So this is a break of structure. Sorry. So let's say, so what you're expecting here is that if you go to 15 minutes, you want to have a rejection. So if you do not have a proper rejection, forget about it. So these are things that you must learn to do if you must achieve the expected result you imagine. Okay. So basically, pay attention to what I've said on the script, and that's going to help you as much as possible. Do have a nice time.